Today we're going to talk about minimum and maximum funded life insurance policies and what they are. If you're doing any type of private banking strategy or the double play where you're leveraging a high cash value life insurance policy to invest in real estate, then you want to have a maximum funded life insurance policy. And the problem is that in today's pop culture world, everybody's been led to believe that life insurance is a bad investment, that you should buy term and invest the difference, that you should buy it for the death benefit protection alone and not as an investment. But the typical life insurance policy that people buy are minimally funded life insurance policies. In the private banking world, we use maximum funded life insurance policies. So stick around and I'm going to talk about all of these in detail and explain why you should have a maximum funded life insurance policy if you're thinking about investing in real estate. Hi, I'm Tom Rutkowski with Innovative Retirement Strategies. And I gotta confess, I'm a bit of a financial nerd. Things like interest rate arbitrage and compounding interest fascinate me. And I discovered the concept of the double play many years ago when I got my insurance license. I had discovered quite early that I could build a policy that had about 85% cash value to premium. And that was completely the opposite of what I had heard life insurance was about as far as the relationship between cash value. I'd always heard that it took years to build up cash value. And I also learned that you could borrow against the policy's cash value. And the real estate investor in me was wondering, hey, could I put money into a life insurance policy, borrow against it, and come out better off than what I would have been? And the answer to that is yes, you can. So I've been on a mission ever since to share this knowledge with everyone. And the goal of this YouTube channel is to demystify life insurance and show people what the true value is of being able to borrow against cash value life insurance to do anything that you want. So today we're going to be talking about minimum versus maximum funded life insurance policies and why you want to have a maximum funded life insurance policy if you're going to do the double play. Essentially, if you're a real estate investor and you're thinking of using any type of double play or private banking strategy, you want to have a policy that's optimized for cash value. You want to be able to put as much of your dollars to work in two places at one time as you can. And the way that you do that is by having a maximum funded life insurance policy, not a minimum funded life insurance policy. All right, so let's take care of some formalities. Nothing in this presentation constitutes financial or tax advice. And the primary reason for purchasing life insurance is for the death benefit protection. Any other benefit is ancillary. The purpose of this content is simply to show you how to do or how you can do what you were already looking for information on while you're doing your search on the internet. In order to talk about minimum versus maximum cash value policies, we need to understand what is the cash value. Not everybody that's going to be watching this video truly understands how life insurance policies work and what a minimally funded one is versus a maximally funded life insurance policy. So we have to explain what the cash value is before you can really understand what the difference is between a minimum and a maximum. And then once we've defined the two endpoints, min and max, we're going to talk about policies that lie in the middle somewhere. And then lastly, we'll kind of close it up and circle back and discuss why you want to have a policy that's maximum funded in order to utilize the double play or any type of private banking strategy. So some of the fundamentals, private banking strategies like the double play require a maximum funded policy. Anything less than a maximum funded policy will increase the payback time. And you want to have something, a minimally funded policy has a death benefit focus and a maximum funded policy has a cash value focus. So in order to understand how a permanent life insurance policy works, what the cash value is, we need to go back and cover what I consider a little bit of life insurance 101. And the easiest way to do that is to put yourself in the position of the insurance company and think about it from their perspective. So if a 45-year-old client wants to have a policy with $1 million death benefit, then how would you do that? And if it was me and I was the insurance company, I would want to design the premium such that that person is going to save up that $1 million of cash, save up that $1 million of death benefit over the course of their natural life expectancy. At the same time, you want to make sure that if that person dies tomorrow, they step off a curb and get hit by a bus, you need to be able to have some type of mechanism in place to cover that risk. And the easiest way to think of that is to simply buy a 1-year term life insurance policy. I mean, that's what insurance companies do. Insurance companies pool risks. So that really that 1-year term policy is just the insurance company collecting premium, enough to cover all of the expected claims, and then paying it out whenever people die. And that leaves enough money to pay all of the expected claims, make a profit, and everybody's happy. So when we couple the savings mechanism with the risk or mortality cost component, you've got the basics of a permanent life insurance policy. Those two things make up a policy. So when you sit down with a life insurance agent and you ask them for a quote on $1 million policy, let's just say you're 45 years old, the life insurance agent, the life insurance company, it wants to give you the lowest price that they possibly can for the death benefit protection that they're offering, because they know you're going to go out and shop around to other insurance companies, other agents, and try to get the best rate that you can, because in a minimally funded policy, you're trying to get the most death benefit protection that you can for your money. So the goal is not cash accumulation. The cash is just there to be the savings component so that the policy operates. And the best way to talk about this is to literally just show you what one looks like on a graphic form. So here on this graph, I'm showing a minimally funded policy. It's a 45-year-old client with a $1 million death benefit. And the blue line represents the cash value accumulation over time. So at issue, at age 45, the death benefit protection is the orange line, $1 million, and the cash value at that point is very little. But over time, assuming some worst case growth rate assumption, the policy is slowly but surely accumulating cash value to the point where the cash value runs into the death benefit out around age 113. So to illustrate the risk that I discussed earlier, at policy issue right in the beginning, you can see that the bracket is showing that there's about $1 million of pure risk. So if the client were to die at that time, they've got very little cost or cash value saved up. So most of the risk is being borne by the insurance company, which is covering by simply buying a 1-year term policy or pooling enough money to cover the risk that they expect or death benefits that they expect to pay out. By the time that client reaches age 79, their cash value has grown to the point where it represents about $500,000, and there's still about $500,000 of additional risk remaining to the insurance company. So at the risk of going down another rabbit hole, you've heard people talk about buying term and investing the difference. And as you can see here, that's really what the insurance company is doing. They're investing the difference and they're buying term to cover the risk. But the thing is they're probably doing it more efficient than what you could do it yourself, because if you were to try and save up the cash yourself to basically replace the term that you're buying, you're going to pay income taxes on all the dividend income that you got from your portfolio, and you're also going to pay capital gains on anything that you sell. So you're saving in a taxable environment, whereas the cash value of life insurance is occurring in a tax-free environment. And as far as buying term, they're able to basically size the amount of term that they're purchasing every year to exactly that amount that's necessary to make up the balance of the $1 million. Whereas you might go out and buy a $1 million term life insurance policy for 20 or 30 years, and as your savings is going up, you're still paying for that. And then by the time you reach age 79, you might get rid of the $1 million term and have a $500,000 term. But now you're paying for that at age 79 rates. So it's really the same thing as buy term and invest the difference. It's just being done more efficiently. And one more important thing that I'd like to point out is that the death benefit protection, the death benefit component of this never really goes away. So even if you live to be age 95, for example, there's still some life expectancy ahead of you. It could be 2 years, 3 years, Who knows? I'm not an actuary. But there's always some amount of risk in a life insurance contract. Otherwise, it's not a life insurance contract. So some of the takeaways. In a minimally funded life insurance policy, you're getting the maximum death benefit for the premium. The insurance company is only collecting the absolute minimum amount that they need in order to perform on the contract. And lastly, the insurance company is incented to maximize the earnings, because the better they do on actually investing the cash, the quicker you save up your own death benefit. If you think of that blue curve in the graph moving up quicker towards the $1 million death benefit, that eliminates their risk, and it keeps the cost of the policy down to a minimum. So bottom line is a minimally funded life insurance policy is not what you want to use for any type of double play or private banking strategy. So let's talk about maximum overfunded policies. So what I have on screen here is a graph showing what an efficient maximum funded life insurance policy looks like. In this case here, it's a same 45-year-old. They're putting in $100,000 a year of premium for 10 years. And don't let the numbers scare you. This could just as well be $10,000 a year for 10 years, and we would just basically take a zero off of everything on this graph. It's the same thing. But as I said earlier, when I pointed out that when the cash value saves up to the point where it runs into the death benefit, it starts to push up the death benefit by some minimum amount of additional death benefit protection. In a maximum cash value policy, we're starting with that minimum in mind. So based on the first year premium, and this is key, remember that, based on the first year premium, the insurance company is solving for the lowest possible non-MEC death benefit over and above that amount of premium. And that's what determines what the costs of the policy are going to be. The fees, the commissions are all based on what that death benefit is. So we want to keep that death benefit to an absolute minimum. So for each of those first 10 years, as each new premium is paid into the policy, the cash value is increasing. As the premium goes in, the insurance company takes out some fees and expenses. It buys the insurance for 1 year, and the rest of it goes to the cash value. And as the new premium goes in and the cash value increases, you can see that the death benefit is being pushed up year by year by year, but it's always maintaining that same minimum corridor that we started with until we get out to the end of the 10th year. So by the time we get out to the end of the 10th year, now that the client has got all their money into the life insurance policy, they basically want to cap it and minimize the cost to preserve the cash value. The death benefit is the primary driver of the cost in a life insurance policy. It's what costs the money. In this case here, it looks like the death benefit is about $2.5 million for that $100,000 a year premium, which makes sense for a 45-year-old. And you can see that if we were to continue paying for that additional $2.5 million worth of death benefit protection, as that client gets older and older, that cost gets higher. And it would be a drag on the cash value of the policy, because once you get to year 10 and there's no more premium coming into the policy, now the costs have to be handled or covered by the cash value. So some amount of the growth of the cash value is going towards covering the cost of insurance. So what happens at year 10? Basically at year 10, in the case of a whole life policy, we have to do two things. Usually a whole life includes some term component that gets the death benefit up, and I'll circle back to this in a minute. But that term has to be dropped, and once that term premium is out of the policy, there's no more expense to it, but the cash value remains. So that's the drop that you see in the death benefit there. And we also need to do what's called a reduced paid up. So you're basically converting all the cash value that you have in the policy to paid up insurance. And I'll explain what paid up insurance is here in a minute as well. In the case of a universal life insurance policy, and that's universal or index universal, the cash value, you just simply call up the insurance company, get a policy change request, and just make the change. And what you're doing is you're switching from an increasing death benefit to level, and reducing the face amount to what's called the minimum non-MEC face. And that's what you can see that in the label here. So we're lowering the death benefit or doing a reduced paid up. Now let's talk about what happens after the 10 years. So you'll notice that once the death benefit is reduced, that there's this narrow sliver of risk that is constantly getting smaller over time. And why is it getting smaller, or thinner, I should say? Well, if we keep in mind that the cash value of the policy represents you saving up your own death benefit over the course of your natural life expectancy, we would expect that amount of risk as your cash value is increasing to basically get closer and closer to the death benefit, but never quite crossing over, because as you get older, you always have more life expectancy. So one of the least understood things about a life insurance policy, a high cash value policy, is just how low the costs are in it. And I'll cover policy costs in detail in a future video. Understand that if you were to divide the cost of insurance by the cash value, the ratio or expense ratio would be about 1/4%. And that amount holds true for the entire time. Like in this policy here, from the time we do the reduced paid up at year 10 all the way through year 93 or age 93. If you were to divide the cost of insurance by the cash value, that ratio is going to stay at pretty much even at 1/4%. And the reason for that is, again, trying to bust a myth here, is the myth is, in a universal life insurance policy, as the client gets older, the rising cost of mortality is going to cause the policy to lapse. If you're searching the internet looking for information on life insurance or universal life, you're going to see this. That's the number one fear that people have in their head about universal life. Well, I haven't said anything yet about whole life versus indexed universal life except for the fact that I explained what gets done at year 10. But this graph is showing an overfunded policy, whether it's whole life or indexed universal life. And the thing I want to make clear is at 1/4%, and that ratio is staying constant over the life of the policy, the risk of the policy lapsing due to rising mortality costs is nonsense. The people that say that either don't understand how life insurance works, or they're purposely misleading you by comparing an overfunded policy with an underfunded or minimally funded policy. The whole life guys like to do that. They like to compare a minimally funded index universal life where the costs are higher, as you saw in that graph. I mean, the corridor of risk is very large, to a whole life that has guarantees. And I would never use an index universal life for a minimally funded policy. But in the maximum funded policy world, there you want to have an index universal life because you want to have the cash value grow even faster. Imagine this curve rising up and to the right even faster than what it is shown here with less cost. So bottom line is the costs are about 1/4% per year, and that stays level throughout the life of the policy. So let's get into the mechanics a little bit. This is going to be pretty detailed. Hopefully this level of detail is what you're after. In a whole life, we have to basically kludge a bunch of components together, because your typical whole life is a minimally funded policy. So if you call up an agent asking for a quote on a $1 million whole life, you're going to get a minimum funded life insurance policy. So in this example, I think I said that the premiums were about $100,000, and it looks like the death benefit is about $2.5 million. The base policy, the basic whole life, is going to be about $10,000. Let's just say $10,000. 10% of the premium is going towards the base policy in that. And that might give a death benefit of about $250,000. I'm just picking numbers out of the air. This is just for example's sake. Don't write an illustration and then hold me to that. But if the base policy has a death benefit of $250,000, we want to be able to stuff $100,000 of premium into it. So how do we get there? Well, we have to bundle that basic whole life with a term rider that allows for, let's just say, $750,000 of additional death benefit protection. So you got $250,000 on the base policy and an additional $750,000 on the term. That gets the death benefit up to $1 million. So now that with that $1 million of death benefit, the policy is capable of taking much more in ways of up to $100,000 of premium without creating a modified endowment contract. So the rest of that premium can go into paid up additions. So I said earlier that I would explain what paid up additions are. The easiest way to understand what a paid up addition is to think of it as the present value of the future death benefit. And if you think of the rule of 72, for example, if the rule of 72 is if you take the interest rate that you're earning on your money and divide it into 72, that's how long it takes for your money to double. So if you're earning 7%, your money should double in roughly 10 years. So if we use that as an assumption, and somebody's, say, 57 years old, and they've got a life expectancy of 87, they've got 30 years left of life expectancy. If their cash value is growing at 7%, which is a little bit unreasonable, but just work with me to keep the math simple, that cash value, assuming no cost on the policy, would grow. The cash value would grow at 7% per year and would essentially double every 10 years. So in 10 years, that dollar of paid up additions would turn into 2. In another 10 years, that 2 would turn into 4. And in another 10 years, that 4 would turn into 8. It's not that efficient, but $1 of paid up additions has some amount of death benefit associated with it. It's typically not that ratio because life insurance does have fees and expenses. So another way of looking at it too would be to look at the blue line on the curve here, and that basically is the cash value supporting the death benefit above it. So a paid up addition would grow and compound and push up the death benefit along with it as well. So hopefully that makes sense. It's basically the easiest way to understand is that it's the present value of the future death benefit. So getting back to my example, we had put $10,000 of the $100,000 into a basic whole life with about $250,000 death benefit. Then we bought $750,000 of a term rider, so that gets us a total of $1 million of death benefit. But we still got $89,000, assuming that the term was just $1,000 to keep the math simple. So we spent $10 on the base policy, $1,000 on the term, so we've got $89,000 that we need to spend. So that $89,000 is going into paid up additions. And depending upon your age, those paid up additions have a death benefit associated with it as well. So if you're young, that $89,000 has a lot of death benefit associated with it. And if you're older, that $89,000 has much less death benefit associated with it. So basically, we can back off on the term because we all we need to do is get to the $1 million mark. So we can back off from the $750,000, the amount of the paid up addition death benefit. Very convoluted in a whole life. It's the combination of the 3 different piece parts. In a universal life, it's as simple as typing in the premium that you want to pay into a program, and the computer knows what the limits are, what the minimum amount of death benefit protection is, and it spits out a number. So it's very easy to create a maximum funded life insurance policy in a universal life chassis. That's not to say that it can't cause mistakes. So like I said earlier, the death benefit is a function of the first year premium. Well, you would not believe how often I see policies that have a lump sum premium payment in the first year. And that is the single largest mistake that somebody can make when they're designing a life insurance policy. And life insurance agents think they're doing the clients a favor, and they don't realize the damage that they're causing, because if you double the premium the first year, you're doubling the death benefit. And you're setting what the costs are going to be for the next 10 years of the policy. So each lower amount in the subsequent years is getting hit with much higher costs. And basically, at the end of 10 years, you're going to give all the money back to the insurance company. So I'm going to have a video devoted entirely to that I don't rush through in 1 minute like I just did. I've also got a paper on my website that you can download that's devoted to just that subject as well. Circling back again, it doesn't matter if it's a whole life or an index universal life. Everything that I showed you on that graph is representative of what a maximum overfunded life insurance policy looks like, irrespective of the underlying chassis. At the end of the day, I still prefer an index universal life because I believe that the cash value is going to capture some of the equity premium and is going to grow at a faster rate than a similarly designed policy on a whole life chassis. So this crude diagram represents the spectrum between a minimally funded life insurance policy and a maximum funded life insurance policy. With a minimally funded life insurance policy, the focus is on death benefit protection. You're trying to squeeze out the highest amount of death benefit for the amount of premium that you're paying into the policy. At the far polar opposite end of the spectrum, you've got the maximum funded life insurance policy. And here the focus is on cash accumulation. So you're trying to get as much cash and keep the death benefit to an absolute minimum, because the death benefit is where the cost comes from in a life insurance policy. So what about everything in between? So I've stated repeatedly in my presentations, all over my website, in a properly designed maximum funded life insurance policy, assuming that you're a healthy non-smoker, your cash value to premium should be about 85%. So for every dollar of premium put into the policy, you should have about 85 cents of cash value. And if you're not seeing that, like you get an illustration from somebody that does infinite banking concept or bank on yourself, they like to include a lot more death benefit protection in theirs. And that is not, in itself, is not necessarily bad. It's just that oftentimes the people that go to the infinite banking practitioner want an overfunded life insurance policy, a maximum overfunded life insurance policy. And the problem is they're getting an overfunded policy, but it's not a maximum overfunded life insurance policy. And if you have a need for the additional death benefit protection, it doesn't cost a lot of extra money to include it in there. The policy is not going to be as efficient as it could be from a maximum overfunded point of view. But that additional death benefit doesn't, if you need it, it is life insurance. So anything that has more cash value in it than a minimally funded life insurance policy, it is an overfunded life insurance policy. But it's important not to confuse an overfunded life insurance policy with a maximum overfunded life insurance policy. Again, if your cash value to premium ratio is not 85%, your policy is not optimized, and you're not keeping the cost to an absolute minimum. You're not getting the most bang for the buck. Just to illustrate what I just mentioned about being able to customize the life insurance policy for you. I had said earlier that the cost of that sliver of risk was about 0.25% per year of the cash value. Well, in this example, it's hard to tell on the $5 million scale there, but let's just say we're looking at about $750,000 of risk in that little sliver where the arrow is. If that $750,000 represents 0.25% of the cash value, it's very easy to understand that we could double that to $1.5 million of additional risk and only increase the cost of the policy by 0.5%, or from 0.25% to 0.5%. And while that's not as efficient as it could possibly be, if you have the need for the death benefit protection, it's not the end of the world. So we can always include the death benefit protection in there. It's just we do have to manage it so that it doesn't cause the policy to get out of control from a fee perspective. I'm going to repeat this. Again, this is key. The single biggest mistake that people can make when they're designing a policy is wanting to include a lump sum of premium in the policy. I have to talk people down off that cliff. I wouldn't say on a weekly basis, but most of the people that come to me want to put in as much money as they have into the policy all at one time. And I have to back them off of that and show them why you want to put it in on a level basis with a minimum of 5 years of funding. I showed a policy design of 10 years here. I consider 5 years to be the optimal. I mean, if you've got a lump sum of money that you want to get into life insurance cash value, a 5-year funding period is the optimal. So just as an example, if you've got $500,000 sitting in the bank and you want to get that into life insurance, you would put $100,000 a year into a policy each year for 5 years. And at the end of those 5 years, you would slash the death benefit to the minimum that you can and change the death benefit from increasing to level. And then it will look just like what's on the screen here. But the key is don't put it all in at one time, because the death benefit is a function of the first year premium. So the costs are spread out over the first 10, 15, 20 years of the policy. Every company's got different surrender charge periods, but most are like 10 years. So the cost associated with that death benefit is hit on the policy every year for 10 years. And if the premium is paid in one large lump sum up front, then the cash value is getting hit with those charges each year. So it's just, you put it in, but it's getting whacked severely each year for the next 10 years. And you end up not at all where you could have been. Had you spread what you had out over 5 years, you would have ended up with much more cash value. You'd think that by going 10 years, you could keep the cost even lower. But the problem with doing it over 10 years is your money is not going to work that quickly. So you don't get as much cash accumulation as you would, even with the lower fees, than you would have had you put 5 years of premium in. If you look at an illustration that doesn't have 85% cash value to premium, your policy is not designed as efficiently as it could be. And when you're using a policy for the double play, or what I call the double play, leveraging cash value to invest in real estate, you want as much cash value as you can possibly get. So if $1 of premium turns into 85 cents of cash value, you've got a line of credit for 85 cents. So you've really got $1.70 that's going to work for yourself before you factor in the interest. So you've got your money working in two places at one time. And when you do that, you're going to earn a superior rate of return, but it's still going to take you time because your dollar turned in 85 cents. So even though it's growing at a faster rate, you got to get back to that dollar that you originally put in and catch up to where that dollar would have been had you just invested it directly without ever going through the life insurance double play. Now, if you step back and look at an inefficient policy like one that had if you look at an inefficient policy like one that has 65% cash value to premium, now when you look at your line of credit, you've got another 65 cents of line of credit, so you got $1.30 that's going to work for you. Well, you've got 65 cents that's working in two places at one time. So it's going to take a long time just getting back to the dollar that your dollar turned into 65 cents, you got to get that back and catch up to where that dollar would have been had you just simply invested it in real estate. And it doesn't work. I mean, eventually compounding interest will take over, but we also want this to happen in a reasonable amount of time. I mean, we have a finite amount of time here on this planet, right? So we don't want that payback to occur over a much, much longer time period. So anything but an optimally designed policy is going to increase how long it takes you to pay back. And you don't want that. In future videos, I'm going to talk about the one big mistake that'll cost thousands. So I'm going to dive into just that topic alone. And then we're also going to take a more detailed look at the policy charges. I touched on both of these briefly in this video, but I want to come back and dive into detail in a future video. And then we're also going to take a look at debunking the common myths of life insurance. So I think both the Infinite Banking folks and the Be Your Own Bank folks have like a top 10 list on their websites as to why you shouldn't buy an IUL or a UL. And we're going to go through that list as well as just the common myths of life insurance in general, which, one example of which is, the life insurance company keeps the cash value when you die. Based on what you just saw here today, you should know that the cash value represents you saving up your own death benefits. So when you see that, you know that it's not true. All right. And lastly, if you're still hungry for more information after sitting through this lengthy, detailed presentation, then I've got the Facebook group that I just recreated about a month ago called the Double Play Group. And that is a community of real estate investors who are using life insurance to invest in real estate. It's people who are my clients. There are people who are not my clients, who are going with somebody else. And there are just people that are interested in the subject. I will pretty much let anybody into it that wants to get into it. I encourage you to go out, talk to people who are doing it, ask your questions. Everybody there is knowledgeable. Almost everybody that ever reaches out to me is somebody who's researched this subject to death and is ready to talk about life insurance at a very high level, at a higher level than most life insurance agents can. So I encourage you to join the community and ask questions of the people who are there. And if you're already part of the community, ask questions of the others. Find out what they're doing. Find out what works for them. Find out where they're getting their loans from. And lastly, my website is a wealth of information on life insurance. So it's a no fluff zone. It's not one of those websites that you go to where there's just kind of nothing, vague terms, but no real substance. Almost everything you want to know about life insurance, you can find here, short of seeing an actual illustration. If you want to reach out personally and have a conversation, the link is at the bottom of the screen to see my calendar and book a time on my calendar. And with that, I'll stop the main video and answer questions. So go down to the comments section right now and let me know, before you started your research into life insurance, did you even know that there was a difference between minimum funded life insurance policies and maximum funded life insurance policies? Or did you think that there was one size fits all?